This week, I took 11 trades across NQ and ES. Some of them worked exactly as I planned. One of them was a bad location trade that should never have been taken. And one trade reminded me why even the best setups can fail. In this video, I'm going to break down every trade I took during the week of June 22nd, 2026. Explain the reasoning behind each trade and show how I use order flow, market profile, and statistics from StatsTerminal.com to make those trading decisions. Let's get right into the charts. Before we look at individual trade, let's talk about the week as a whole. Throughout a week, I traded both NQ and ES, focusing on combination of market profile level, VWAP, RTH open statistics, initial balance, and higher time frame support and resistance. My goal is not to predict where the market will go. Instead, I'm looking for area where statistics suggest a reaction is likely to happen, and I'm using order flow to confirm whatever the buyers or sellers are actually taking control. If you watched my previous videos, you already know that RTH Opening Print is one of my favorite setups. The idea is simple. When price reclaims the opening print and the market conditions support the move, there's often a strong probability of continuation. In this case, price closed above the opening print, and it was right at the time when we noticed a reversal. We got that stats from StatsTerminal.com. The order flow supported the move and buyers were showing strength. Once the setup confirmed, I enter long. The market responds almost immediately. As the price moved higher, I scale out of several of my contracts and I let the runner run. This is basically a textbook example of how I trade a trade like the opening print setup. The second trade used the exact same concept, but in the opposite direction. Earlier in the session, the market attempted to push higher and test new highs. However, after the test failed, price rotated back below the opening print. The order flow became noticeably more bearish and seller began taking control. That gave me the confidence to enter short. As the trade developed, I stayed in the position until I noticed a significant buyer activity entering the market. Large buyer began absorbing the selling pressure, and I decided to lock in profit. The lesson from this trade is that statistics can provide a target, but order flow can help determine when it's time to exit. For the third trade, price tested value area low. This is one of the most important levels in my charts because it represents lower edge of the fair value. As the market reached that area, I watched for the order flow closely. You can see here in the blue rectangle. The seller tried to sell this level. They became a lot more aggressive, but they weren't getting the downside continuation they expected. Instead, the price looks like it started to stabilize. So that was my signal to go long. I enter long and use the value area low as a reference. I quickly adjust my stop to break even after the higher low on the 1 minute chart was confirmed. The market rejected the lower price and rotated higher exactly as anticipated. The next trade is important because not every trade is a winner. The setup itself wasn't necessarily bad. The problem was the location. I entered the market in the middle of the range instead of waiting for price to reach an area where buyers and sellers are likely to defend. Whenever you trade in the middle of nowhere, your edge decreases significantly. Fortunately, I recognized my mistake quickly and managed to exit around break even. Sometimes the best trade management decision is simply not losing money or just staying out. The fifth trade came from a 15-minute breakout pattern. This is another one of my favorite setups. Price was consolidated near the POC. This is where the previous trade was in a bad location. So I was looking to see if buyers gonna break above resistance because we had a lot of sellers at the top there. As the buyers finally broke above the resistance, the order flow confirmed the breakout. I enter with expectation that the sellers at the high will be trapped and maybe help fuel the move since they have to cover. The breakout works as expected and provided a clean continuation trade. The target for this trade was at the low volume node above and also VWAP, but I only managed to hold the trade to the low volume node and I scaled along the way. If you're interested in trading the opening range breakout, you can actually study this setup directly in StatsTerminal. Using the 15-minute ORB command, you can analyze the performance of the 15 minutes opening range breakout for NQ, ES, and YM. The tools allow you to review the statistic over different time periods, including the last 30 days, the last year, and even a larger historical samples. Instead of guessing whatever the breakout is likely to work, you can see the actual historical performance and understand how the market has behaved under similar condition. That's one of the reasons I like using statistics along with order flow. The statistics tell me what historically happened, and the order flow help me understand what's going on right now. The sixth trade was a value area low breakdown setup. Unlike trade 3, when buyers defended the value area low and pushed the market back into value, at this time I was expecting a breakdown and continuation lower. As price approaches the value area low, I wasn't looking for reversal. I was looking for acceptance below the level. When the market finally broke the value area low, I started analyzing the order flow and the heat map to determine whatever the sellers could maintain control. One thing I noticed that I didn't like was that the cumulative delta was actually moving higher. Normally, rising cumulative delta suggests buyers are becoming more aggressive, which can be a warning sign for a short trade. At first glance, that seems to conflict with my bearish thesis. However, when I look deeper into that heat map, the liquidity below the market was telling a different story. There was a significant amount of resting liquidity sitting underneath the prices, acting like a magnet for the market. In many cases, prices will seek out the liquidity before finding meaningful support. So while cumulative delta was showing buyers becoming active, the liquidity structure suggested that the market still had unfinished business below. This is an important lesson because no single tool should be used in isolation. If I had to focus only on cumulative delta, I might have avoided that trade completely. Instead, I combined cumulative delta information, the market structure, the value area, acceptance, and the liquidity shows below. Once I saw the seller maintaining control below the value area low, I enter short. The market continued lower and eventually moved into liquidity resting beneath the market, allowing the trade to work as expected. The lesson from this trade is that conflicting signals are normal. When that happens, I try to identify which factor is most likely driving the auction. In this case, the liquidity below the market provided the clue that helped me stay in the bearish mind. Trade number 7 was a continuation setup that combined value area low breakdown like before with an RTH opening print statistics. At this point, the market has already accepted below value area low, which suggests sellers are still in control. As the prices attempted to move higher, I started paying close attention to the heat map like I always do. What caught my attention was the seller continuing reloading their position even after the market offering at higher prices. Normally, if buyers are truly in control, higher prices should attract additional buying and push higher. Instead, every rally attempt seems to find more sellers waiting. At the same time, I noticed additional liquidity appearing below the current market price. This was important because it suggested market still have unfinished business below. The combination of sellers absorbing above and fresh liquidity building below created a bearish picture. However, the biggest clue came from the heat map point of control. As the session progressed, I noted the POC began to shift lower and move closer to the current market price. For me, this is an important sign because it suggests the value is migrating lower. Rather than the buyer accepting higher prices, the market was beginning to establish a value at lower prices. The trade aligned also with the RTH opening print statistics, which added another layer of confluence to the idea. With the market profile, order flow, heat map liquidity, and statistics all point to the same direction. Lastly, once I saw the POC shift lower and the market failed to continue down, I decided to take the trade completely off. The lesson from this trade is that when sellers continue reloading at higher prices, liquidity building below the market, and the POC beginning shifting lower, it can be a strong indication that the auction is preparing to move lower. The 8th trade was taken on ES this time, and it was based on a key 4-hour resistance level that I had identified before the session began. One thing I always try to do before the market opened is to mark important level higher time frame levels. While most of my entries are based on a short-term order flow and market profile, I wanted to know where a larger participant may become active. Before taking the trade, I also checked the 4-hour statistics on StatsTerminal. The statistics shows that this resistance area had historically produced reaction, which gave me additional confidence that this level is going to hold. As the session developed, ES continued to push higher and eventually approaching that 4-hour resistance zone. Whenever price reaches a major higher time frame level, I'm not interested in blindly fading it. Instead, I wanted to see an evidence that the market is actually responding to that level. As the price tested the resistance, I began monitoring the order flow as usual. What stood out that the buyers were still aggressive, but they were becoming less effective. The market continued to receive buyer pressure, yet prices were struggling to make a meaningful progress higher. This is something I often look for at major support and resistance level. When effort increases but results decreases, it can be an early sign of the auction is running out of fuel. At the same time, I noticed sellers beginning to observe some of the buying pressure near the resistance area. The market attempts several times to trade higher, but it could not attract enough participants to sustain the move. That gave me the confidence that this level is going to hold. Once I saw the rejection developing, I entered short and used the resistance area as my risk reference. The trade works as expected and the market rotated lower from the resistance zone. If you like to research these levels yourself, StatsTerminal will include a 4-hour support and resistance statistics for NQ, ES, and YM. You can analyze how price historically react around those levels and review the data across different time periods. The lesson from this trade is that the higher time frame level becomes even more powerful when supported by statistics and confirmed by real-time order flow. Trade number 9. By the way, if you like this video and you're getting useful information, click the like button and subscribe to this channel. The 9 trade was very similar to the previous setup. However, this time I had an additional piece of information. The market created a failed auction, and if you watch my previous videos, you know how I like failed auction because it contributes to the force of the trade. For those unfamiliar with the concept, a failed auction occurs when the market attempts to move higher but cannot attract enough participants to sustain the move. Price quickly rejected the extreme and rotate back into the range. If you combine this for our resistance and relevant stats, this provided even a stronger case for the short trade. The trade worked exactly as expected. The last target was the VWAP, which was in the HVN area. Trade number 10 was the ES VWAP short, and it was a loss. Not every trade works. This is another favorite setup of mine, is to play the VWAP level. This trade was an ES VWAP shorts that resulted in a loss. The setup looked reasonable at the time. I thought this could be a continuation setup since we had an opening drive at the opening, right at the open. Prices was testing VWAP and sellers appear to be active. However, buyers absorbed the selling pressure and quickly regained control. In this case, it's best to take the loss and continue forward, right? Losses are part of trading. The goal isn't it to avoid losses entirely, it's just to keep them small. And you will see the next trade that I took the same trade and actually worked. The final trade of the week came shortly after the losing VWAP trade. It's basically the same setup. Many traders struggle after a loss because the emotional part. Instead, I focused on what the market actually doing. The order flow shifted and the setup improved, and I saw the opportunity again. I took the trade and managed it conservatively. The move wasn't huge, but it provided a solid scalp, and that ended the week with a positive note. So to recap, looking back at the 11 trade, a few themes stands out. First, location matter. Most of the winning trade came from important levels such as value area high, value area low, VWAP, opening print, higher time frame support and resistance, etc. Second, order flow is the most powerful when it comes to contacts. Aggressive buying or selling by itself isn't enough. You need to understand where it's happening. Finally, statistics help to identify high probability opportunities, but execution still matter. The statistics provide the roadmap, the edge. Order flow provide the timing. And risk management keep you in the game long enough to benefit from both. Thank you for watching this video, and if you like to learn more about trading with statistics, market profile, and order flow, make sure to subscribe and check out StatsTerminal.com. Thank you and have a great week.